What's up, guys? This is your Monday Nerd Report on the weekly trend for October 10th, 2022. I'm Jamie Tajera, co-owner of Property Bear here in Jacksonville, Florida. This is Carrie Hustis, co-owner and sales leader. While Carrie runs all things sales, my day-to-day hunting investments and developments keeps me in two main places. In the field, checking out potential opportunities in construction, or on the computer researching hyperlocal data. So if you're looking for insight on Jacksonville real estate, you've come to the right place. Thanks for checking out our channel, and if you like it, please be sure to subscribe. All right, so let's get into it. Last Monday we did the monthly, where you could see some of those numbers for in September pricing definitely pivoting down. I think we're down like 5.5% from the highs in June or July. So on the weekly, when we're looking at these weekly charts, the moves are more like volatile, if you will, because, you're looking at a smaller sample size, and so it moves a lot more. Also, this is the median. So when we looked at it last Monday for the month, I think our average, right, because I like the averages, we're at like 420, I think, right now, somewhere like that. And then in the median, we're at like 369. Again, we like the averages because that's how you pull comps. That's how you do most of your stuff. But there is an average we can actually look like. So our median right now is at around 370. Looks like from a weekly basis from September 17th as a recent low, I would say, which is similar to April. It's up year over year. We're still at 20%. And I think we get a CPI report on Thursday, but there's not going to be a Fed meeting in October, I believe. So in November, they'll, right now everybody's talking about 75 points. So I think that's where it's going to go. Anyway, so we see, from a weekly basis, the median price point going up. Again, on these weekly trends, you're looking at much lower volume of homes, so it can kind of sway the number a lot more, and I'm pretty sure we're seeing for the first time in 2 years seasonality again. So what happens is in Q4 there's lower inventory, lower volume of houses, and so prices tend to go up a little bit. I know it sounds counterintuitive. Yes, there are less buyers. Some houses don't sell at all, but what happens is people are still getting job transfers, end of the year. So, and people are always like, oh, we're going to wait till the next year to sell our house. So there's not a lot of inventory in the market. So the ones that are on the market tend to sell a little bit better, or command a bit of a higher price. Now, relatively to this year, that's a little weird. But if we go back 3, 4, 5 years, since 2009, 10, that's generally what happens. Lower inventory, commanding higher pricing. All right, so looking at our sold price per square foot, we're still looking at a median. Remember, on the weekly trends, it only gives us the option for median. So basically, we went from last week 214 to 208. Again, the amount of inventory that we're looking at is basically what's going to set, that trend. And you can kind of see since June, July, we've been kind of barcoding over here. Then we hit this little low, I guess, at the beginning of September. Now we're October. So for active inventory, we reached this high September 24th of about 6,800 homes. And then now we're starting to trend down on a weekly basis. So we didn't do the weekly last week to be able to see it trend down. But again, this is where I think seasonality is coming into play. We'll see days on market come down too. And we'll probably start to see pricing go back up. And if the Fed's looking at home pricing for that, and this is happening around the country, they're going to think that their battle against inflation isn't working. But this is just seasonality that we haven't seen in the past 2 or 3 years because it just is what it is. So, so days on market, we spiked up here October 1st at 42 days. And we will break down the numbers based on the 3 pricing brackets, but you've got 42 days on the 1st, and then now we're at 35 days. Doesn't seem like a whole lot, but a week difference in marketing time makes a big deal. And then looking at our cash sales, we're still at about a quarter, about 30% of homes are selling. So this is what makes us believe that we're going to have another housing rush, especially in Jacksonville, because, I mean, when you look at the hedge fund numbers for other markets around the country, they're somewhere between 10 and 15%. In Jacksonville, it's still really, really high. No state tax. There's a lot of benefits to institutions buying build-to-rent houses here. And here's what's happening in the background that a lot of people don't know. On some of the land deals we're looking at, and some of those larger developments, they're not going to your custom home builder or your general home builder that just builds spec houses for end buyers, which they're going to build to rent companies, and those guys can actually pay more because they're not looking for a margin on the back end. To them, it actually works out better for them to build new versus buying old, even if it's renovated, because they can control their cost and they control the construction now. They didn't used to. They used to sub all that out, but now they control the construction, so they can basically mitigate their risk for maintenance over the next 20, 30 years or however long this play is. And honestly, I think that build to rent is the new mortgage-backed security. It's getting harder and harder based on these interest rates and home prices just in the last 24 months for new entry-level home buyers to get into the game of owning a home. And what's the biggest part about owning a home? It's how most people and most generations over the past 4 or 5 generations have built their wealth, even without a savings account or without anything. They own a home and they just hold on to it, for as long as whatever, and they create inheritance, right? They move up, buy a bigger home, et cetera, et cetera. And if you take away that first Lego block, that first stepping stone, you can kind of see where I'm kind of going with that. It just makes it much harder to get into that. And you've basically institutionalized the building of generational wealth through one simple homeownership plan. Another thing we'll look at, and we'll break this down too in the on our Instagram post. If you check out our social media, it's easier just to break down there because we can actually show it to you. And if you're listening to the podcast, again, check out the Instagram and you'll see the breakdown. Distressed units, they're down. There's no reason to believe that these are going to spike up anytime. Remember, in the last 2 years, we've had ridiculously low interest rates. It's basically free money, 3-4%. And it's, going into distress right now doesn't make a lot of sense because it costs you more to foreclose on your house and go rent. It's not 2008, 2009, so it's definitely a very weird situation because, not in a bad way, but we kind of do like that, having that inventory, because from a flipper's perspective, buying at the auction is a lot simpler and cleaner, to be honest, and it gives us some inventory to be able to renovate and resell. But right now, that inventory is just not there. So, and then the other, all right, percentage of homes closing above list price. So you can see May, June, you can see this whole little section. Even over here, you've got 30s, 40, 50% of the houses selling above list price. Now, keep in mind, we've talked about this. There are a lot of agents, even some experienced ones, that are using month supply of inventory to gauge the market as a seller's market, but we're not in a seller's market. We're honestly not in a buyer's market either. Go back and watch some of the other videos. We're just in a Jerome Powell market right now. But yeah, you can see we're now around 10, 12%. I could take this statistic and make it sound real scary, down 55% or whatever. But honestly, it's not that scary. This is way more normal. This is what a normal market's supposed to look like. And yeah, so plugging some of our stuff right now, in our links now, you can use the same software that we use to find pre-foreclosure information, probate, any type of absentee owner, basically where we go to find leads to try to buy these houses and fix them up and rent them or sell them or whatever, or just basically give the seller the option, like, hey, do you want to sell it to us, or do you want to go with one of the hedge funds, or do you want to list with our team, because they're awesome. Obviously they list all of our flips, like they they get to tinker. And then we've also got the link to our newsletter. Check that out. If you like listening to this, but you don't like watching it, we also basically just take the sound and throw it into our podcast. So if you are listening to our podcast, thank you for that. And then we've got a link to our website and stuff like that there too. But also on that link for the software that we use, we're basically just going to load up everything we use there. You can see 2 softwares on there. And one of them is where we actually pull the data from, and then the other one is actually where we get the information for the homeowners from. The first software will allow you to do that. We just haven't been very successful with that data that we get, and we're not really biased towards it. We're just like, hey, this is what's working for us. But I think every market's going to be a little bit different. So I hope that was helpful. If we can help you in anything with real estate, let us know. We're still buying houses. We're still renovating here in Jacksonville and surrounding areas. Yeah, thanks for checking us out.